for the National Association of Manufacturers. The manufacturing industry in North Carolina is the cornerstone of economic competitiveness. 10% of our state's citizens work in manufacturing, and the economic output in 2022 was over $100 billion. What's made in North Carolina makes North Carolina. The Manufacturing Council was created as a way for our state's manufacturers to look at solutions for today's challenges. We've explored workforce issues, supply chain, regulatory challenges, and most recently, the role of AI in manufacturing. The council is typically open to NC Chamber cornerstone level and above members. We open today's meetings to all manufacturers because the topic is vital in preparing for the year ahead. If you're not already a member, I encourage you to consider joining the NC Chamber and the NC Manufacturing Council. Our member network is impressive and shares an interest in making North Carolina the #1 state to live, work, and raise a family. Adding your voice to our member community ensures your business is well represented and at the legislature, in the courts, and the communities statewide. A few housekeeping items before we hear from our speaker today. All attendees are muted to avoid any distractions during today's presentation. If time permits, we will answer as many questions as possible at the end of the presentation. If you would like to submit a question during the meeting, please use the Q&A feature. Today's sessions will be recorded and slides will be shared with you in a recap email that's sent after the event. It's now my pleasure to introduce Matt Martin, Regional Executive at the Federal Reserve Bank of Richmond. He is based in the Charlotte office, where he leads the bank's outreach efforts across North and South Carolina. As part of the nation's central bank, the Richmond Fed supports the monetary policy process by engaging business, banking, and community leaders throughout the district to gain a real-time understanding of the state of the economy and the challenges facing our communities. Matt joined the Richmond Fed as regional economist in 2006 and was promoted to his current role in 2009. Prior to joining the bank, he worked as a senior economist for Moody's Analytics as an analyst at the Congressional Budget Office. He also spent time as a faculty member at Kent State University, where he taught macroeconomics, money and banking, and economic history. A Pennsylvania native, Matt has a bachelor's degree in economics from the U.S. Military Academy at West Point and a doctorate in economics from the University of Delaware, which he earned after completing his military service. Matt, the virtual floor is yours.
Thank you, Beth. Good morning, everyone. It's great to be with you. Great to support the work of the North Carolina Chamber. I wish we could do this in person, because then we could have even more interaction, because I'm curious on the viewpoints all of you all have. But we'll go through this and I'll leave time for questions. And the title I have here is Solid but Uncertain. And, you know, I don't typically tell a joke to open a talk, because there are only like 3 jokes about economists and the rest are all true stories. But there's this long-standing joke about this guy in a balloon, hot air balloon, and hot air balloons obviously get blown whichever way the wind blows. Doesn't know where he is, so he lowers the balloon, and as he gets close to the ground, he sees someone walking along the ground. He shouts down, "Hey, can you tell me where I am?" And the man looked up and at the guy in the balloon. He says, "You're in a hot air balloon about 30 feet above the ground." And the guy says back to him, "Well, you must be an economist." And he goes, "I am. Why? How do you know that?" He said, "Because the information you gave me is technically accurate and totally useless." Hopefully that won't be the case today, but we're in this uncertain time where there's a lot of policy coming that's going to impact particularly the manufacturing sector, but we don't know what exactly that policy is. So we go into this with a very solid economy, and so we'll see what happens. So I'm going to talk around the parameters of that in some detail. If you go to the next slide real quick, this is the standard disclaimer. My views are my own, not necessarily anyone else in our bank or the Federal Reserve System. And if you go on from there, I'll sort of give you what I think is the bottom line up front. We came into 2025 with a national economy that was in very good shape, and expectations for the year are still for a very strong year overall. The consumer looks good. There's some signs of stress, particularly at lower income household level. and maybe working up in the middle income, but for the most part, holding up well. Job growth's good. That's supporting consumer spending, and there's wage growth there as well. That leads you to labor markets. Labor markets are holding up well. Unemployment's at 4%. But it's more imbalanced, right? And when I talk to manufacturers across the state, 18 months ago, they would have said, finding workers, that's my top concern. I don't hear that near as often anymore. So labor markets are much more in balance. Inflation's moderated, but we actually are starting to see inflation stall above our 2% target. There's good reason to believe we'll make more progress this year, but policy could be a headwind there. Within that context for the U.S. economy, North Carolina is doing better than the U.S. as a whole. Now, I understand a lot of you might be based in North Carolina, but your markets are outside the state. So the national outlook there probably matters. But to the extent that we have an expanding labor force because people are moving here, and to the extent that you have markets in the state, I don't see anything that would cause North Carolina to not continue to perform well and to perform better than the U.S. Now, within that, there's always risks to the outlook, and policy uncertainty is the big one right now. Obviously, for you all, for manufacturing, tariffs are number one. Immigration probably close behind that, but there's other pieces of this. Deregulation might matter for some sectors within manufacturing, and fiscal policy changes. Those are all still to be determined. But what I would say, and we'll talk about this, when the economy has momentum and is doing well, it actually takes a pretty good shock to shake it off its growth path. We had those, right? The pandemic obviously was a big one. Before that, we had a massive housing and housing finance collapse. We had 9/11. These are really big events that caused recessions. So absent some really remarkable big policy changes, I think the U.S. economy has some effects, but continues to move forward unless a larger risk materializes. And then I'll say a few words at the end about our longer term fiscal outlook, just because it's not great, and I feel obligated to at least mention that. Next slide, please. So let's start with the overall picture for GDP. The blue bars here are quarter-to-quarter changes in real GDP. And if you look, we've got 9 quarters in a row through the end of last year. And actually, we've got the fourth quarter figure in, was a solid growth figure as well. That's just steady, good growth. And you see one forecast here. We'll get an update of this forecast next month. Every other monetary policy meeting, so 4 times a year, members of the Federal Open Market Committee put in a forecast that includes fourth quarter year-over-year GDP growth. The orange diamonds are the median of those 19 members, and then there's bands around that gives you the range of their forecast. The bands are pretty narrow, and the median forecast for the forecast horizon is right at 2%. That's as sanguine a forecast as you can get. And when you look at private sector forecasters, they're looking for 25 to be a pretty decent year, a little bit slower growth maybe than last year, but last year was fairly strong. And so from that perspective, it looks good. And when you look at what's supporting that, we have to start with the consumer. So if you go to the next slide, this is year-over-year changes in consumer income, disposable income in red, and expenditures in blue. There's a lot of noise there around COVID when spending dropped, but then we gave households a lot of income payments to households, these large checks that were sent out. We're past all that, and those red and blue lines are growing pretty closely together, which means income's growing at about the same pace as expenditures. Maybe income's a little softer compared to where it was, but it's still fairly healthy. And so that's important. I think it means that consumer spending growth is largely sustainable. And if you go to the next slide, please, one of the things that's not income that's supporting it is household wealth. Now, this chart is household wealth, the sum across all households as a percentage of household disposable income. So income's going up over time. but wealth is going up faster. In fact, from 2014 to our last reading, there's some wiggles again around, especially around COVID, but you can draw a trend line there that shows wealth just going up at a pretty good rate. And that's household wealth is really two components. It's the equity in their homes, which has gone up a lot for those that are homeowners, and it's what's in their retirement accounts, which is largely equity market driven, and that's gone up in the last couple of years. So households are wealthier. That's supports spending and as well as job and wage growth. If you go on to the next slide, there are some changes in what consumers are spending their money on. And the shorthand story that I think you probably all know that we've told over the last several years is COVID hit, everybody's working from home. They want a new desk, a new chair for work. They want the Peloton because they can't go to the gym. And then as everything reopens, nobody needs a Peloton anymore, but now they all want to go to Taylor Swift concerts, right? So the shift in spending away from goods to services, which include travel, entertainment, catching up on doctor's appointments, things like that, that continues apace. And so when you look at the breakdown, and the top line here is overall real consumer consumption expenditures at the level. And then below that, you see the breakdown between services and goods. The blue lines there are just guides to give you an idea of where trends are. They're not scientific in any way. But you can see that where we're sitting now, the growth in services is above the pre-COVID trend, more or less, whereas manufacturing is just on that trend, which is still good, but it's not where it was, say, in 2021, as far as consumer spending on goods, but it's still pretty good. And then if you go to the next slide, please. If you look at the durables, auto sales, that's the solid blue lines, the total at the top. We're right about 16 million units. Most people in that industry don't think we're going to get far above that. So that is largely recovered, but there's probably not a lot of room for growth. We do have a fleet of cars on the road that is as old as it's ever been, so there's scope for that. But cars are expensive, both new and used, right? I keep waiting. Was in the used car market this past year, and I kept and am in the market again, and keep hoping for prices to soften a bit. But we haven't seen that yet. So, and then the other sort of big ticket item, if you go to the next slide, is home building and home sales. And right now, nationally, there's a struggle to even get back to the average of the 90s. And that's I know in North Carolina, we've got a lot of industry that's tied to home sales, particularly furniture, but other ones. We're doing well in North Carolina as far as home building. We're one of the better states for it, but everywhere you talk to home builders, it's the same sort of things. Permitting takes longer, land costs are expensive, everything's more expensive, and working capital gets tied up. So it's just a really hard slog to build new homes. And then, of course, on existing home sales, you've got a lot of households that have 3% mortgages that don't want to move if they don't have to. So the supply of existing homes onto the market's quite low. So home sales in the existing home market are low. What's taken its place is there's a lot of projects to upgrade homes, and you hear about that quite a bit. And so there's some demand that spills over into the relevant sectors of manufacturing from that, but it doesn't seem to be quite the same as just building out new homes and the spending homeowners tend to do when they buy a new home. Next slide, please. So that brings us to thinking about policy in this context, right? A consumer that's doing pretty well, overall economy that looks good, but we have a lot of policy changes in the pipeline. And I think there's a couple of aspects to this. One is the uncertainty itself. So we don't know really how policy will settle out in a lot of these areas. And I'll talk about tariffs primarily, but immigration, fiscal policy, deregulation, all those things are still unknowns at this point. Uncertainty itself has economic impacts. And you got to think about this at the margin. So there are big projects that have to do with long-term demand and productive capacity. When I talk to manufacturers, those are going forward, right? So things that have long lifespans that are critical, that's going to happen. But I think there's a lot that's at the margin, right? So hey, I'm small to mid-sized manufacturer. I've got to make a decision on that next machine I'm going to buy or upgrade. Really is tied to demand. I don't know whether to do that. So if I'm uncertain, I'll wait till I have more certainty till I make that decision. I think there's a fair amount of that going on right now, and it will depend on how policy plays out and evidence that demand is holding up amid all of this change in policy before some firms are willing to pull those triggers. So hopefully, as the year progresses, we get more clarity on what the policies are, and you start to see how that plays out. So the uncertainty is one big one. I think that could be a factor that makes the first quarter in particular a little bit softer, because I think on the consumer side, we're starting to see uncertainty as well. This might be more regional. The DOGE stuff that's going on is going to affect particularly DC. That's part of our district, by the way, so we're closely watching what's going on with employment and initial claims for unemployment in DC. But it's broader as well. I don't know if you all saw NC State last week announced hiring freeze because they're worried about federal grant making for research purposes and some of those things that support university work. And so they're being cautious, right? So uncertainty is having some impact already. Hopefully that gets lifted as the year goes on. As far as the other things, with tariffs, you can pick your scenario and you can sort of war game some of the impacts, right? So the 10% tariff on Chinese goods, it's a couple of tenths effect on pricing, which is a headwind for us as a central bank trying to control inflation, but it's not a game changer. And how do you get that number? Well, imports are 15% of GDP. Chinese imports are 13% of that, and you're going to raise those prices 10%, assuming it gets fully passed on. So you do that math and you get about 0.2%. You can come up with other scenarios. Obviously, we've got the steel and aluminum tariffs that are quite large. Those will work their way in time through to consumer prices, through autos, through anything else that has steel and aluminum in it. And so there will be some impacts there as well if those stick. And so we'll just have to see what that looks like. Then you have the prospect that there will be retaliatory tariffs as well. For North Carolina, right now Canada and Mexico are sort of on hold, and we'll see what happens whether that holds up. But Canada, Mexico, and China making up the three most important destination for exports. And then, of course, Europe and other Central American, South American countries would fill out probably a top 10 list. The one factor that does come into play here that could limit the impact of tariffs on imports, at least it would work the opposite if they're retaliatory on exports, is you may have exchange rate movements. And there's a belief out there that China in particular would manipulate its currency so that the tariffs have a smaller impact on pricing. And that could very well be the case. We'll have to see about that. So there's a lot there. We've tried to get a little bit of an insight from surveys that we do on a monthly basis. We had these for both services and manufacturing. At the end, I'll see if I can recruit some of you to participate in that survey. But last month, we put out a special question on a couple of them. This one is on sourcing and sale of goods. So the darker blue bars are the share of companies who responded. So we pulled out all the not sure, not applicable. So those for which for the share of companies for which this matters, it tells you the share of products sold outside by these different bans, and then the share of imports resourced. And notice if you look to the far left, for most companies, about 2/3 of them, they don't sell outside the US in our survey. Now, I don't have a sense for size. It could be all those are the smaller companies, and the multinationals do sell outside the US. I don't know about that, but for a lot of companies, the trade thing doesn't really matter as far as their outputs. But if you look at the lighter blue, um, a pretty good share have some of their sourcing of inputs from outside the US, and so that matters. And I've had a number of conversations in the last couple of months with manufacturers who they said, "Hey, last time we had Chinese tariffs, we started to move away from China as best we could for sourcing our parts or inputs. Mexico was a popular destination, and if tariffs go on Mexico and you ask them, well, what's your response there? They kind of shrug their shoulders and say, I don't know what we'll do. We'll have to wait and see." And that sort of gets to this next question. If you go to the next slide, this one sort of surprised me. The question here is, how do you anticipate your sales and sourcing changing over a 1-year time frame in dark blue, and in the lighter blue over 3 years? And in both cases, the highest bars are there in the middle at stay about the same, but the decrease and increase somewhat are similar in magnitude of response, which is a little bit of a surprise to me, right? That there are a number of firms out there, and it could be because they're anticipating growth, that they anticipate that they're going to have to increase their sales or sourcing outside the US. But just an interesting response. It just suggests that the international connections, particularly for manufacturing, aren't going to go away anytime soon, right? And I think you probably all know that. Okay, so on to the next slide, please. Let me just wrap this part up, and I'm going to spend some time on workforce, but wrap up on a couple of things around monetary policy in particular, and inflation. So here's the inflation picture. Next week, we'll get the January data by our preferred measure, and this is the one by which we have a 2% target over the medium term. The January data for this will probably show year-over-year inflation ticking up to about 2.7 or 2.8%. And then again, you see a forecast from members of the Federal Open Market Committee. As of December, they expected inflation would end this year above our target. My guess is that will probably tick up a little bit, maybe, and then by the end of 26, that we're largely back. There's good reasons to think we'll get back to our 2% target, but we do have these headwinds. If you go to the next slide, it gives a little bit of insight into what's causing inflation to stay above 2%. So let me highlight where manufacturing is. Core goods is the yellow bars here. So every month we break down inflation, year-over-year inflation, into these different components. And you can see in 21 and 22, in fact, into 23, the yellow bars were pretty large, and then they started to diminish. Goods pricing was adding to inflation, but since really the start of 24 or late 23, very little inflation coming from the good side. In fact, it's been a little bit deflationary on the whole. The green bar is the biggest component as you look far to the right there. That's core services excluding housing. One of the factors that's really a problem right now, and you'll see this, I'm sure, in your businesses, is insurance. Now, this is consumer level, so this is consumer homeowners and auto insurance. Insurance rates are going up quite a bit, in part because costs of construction are going up, home values are going up. On the auto side, auto values and auto repair work is going up in price. Insurance rates have to go up to cover all that. There are some other things as well, but that's one that gets the most attention right now. And then the blue is the shelter or housing component, still a little elevated. Rents, these are based on market rents. Rents are really soft right now, so this should come down this year. But this year is a window, right? There's not much multifamily units going to come on the market in later this year and maybe early next year, and demand is still pretty strong because mortgage rates are high. It's expensive to buy a house. So the thinking is this year housing shelter costs will soften, but then they'll start to strengthen next year. We'll see. But again, potentially headwind down the road. On to the next slide, please. As far as interest rates, and I'm going to go through a little bit on policy, but then longer term rates, because I think that matters for businesses who need to borrow. The red star shows where we are. We've cut our overnight policy rate by 100 basis points. Again, this is from December. We'll get an update in March. It basically shows that there's not a lot of expected rate cuts over the next couple of years, maybe another 100 basis points by the end of 27. And I've put in box this longer run, these longer run dots. These are individual members' estimates of what think of it as the neutral policy rate is. It's centered on 3%, but it's as low as 2.25% and as high as 4%. And that's because it's hard to know what is the rate at which the Federal Reserve is neither tapping the brakes to slow the economy or hitting the accelerator and trying to help the economy grow a little bit faster. Those estimates change over time. And if you go to the next slide, this shows you going back some years what the FOMC members' estimate was for the longer term rate. You go back more than 10 years and they thought it was 4% at the median. That dropped to about 2.5%, and now it's working its way up. This is the real interest rate, right? It's the longer term neutral policy rate is 2% to compensate for inflation. That's our target, plus whatever the real cost of funds are. And why would they be going back up? The economy's stronger, productivity that I'll mention in a minute is stronger, and opportunities for investment are more, particularly as we think about AI projects coming into the marketplace, and for manufacturing, I just think generally automation and other projects. Because when I get to the workforce piece of this, we're probably short labor for a good period of time, and those automation projects probably are make more sense, which would tend to drive up the real rate. The problem, if you go on to the next slide, is we can move short-term rates around, but long-term rates move for a lot of reasons. And this one just shows you how anomalous the current episode is. So the vertical line is the timing of a first Fed rate cut. The red line shows you what the 10-year yield has done before and after, on average, in times past when we've started to cut rates. The 10-year starts to fall before we cut rates because usually there's noise about rate cuts and markets incorporate information right away. And then they sort of stay steady and eventually fall a little bit more. The blue line is what happened this cycle. Everything looked typical until we got to the first rate cut last fall. And since then, longer term rates have actually gone up. And there's lots of reasons for that. That are outside our control, but that's an interesting and different development. On the home buying side, it means mortgage rates are higher, so it makes it more expensive to buy a home. On the business side, it means the cost of funds is a little more expensive, and so that might be a headwind to investment projects. Next slide, please. This is my final slide on this part, and then we'll talk a little bit about workforce. One factor that may have some bearing on longer term rates is our federal fiscal situation. The CBO, where I work briefly, every year they update their projections. This is from January. They just updated them. This is the national debt held by the public as a percentage of GDP. And you can see the previous peak was around World War II. So debts started going up World War I, Depression, World War II, and then we quickly worked it back down to a more manageable level. The forecast shows that we're near that previous peak in the mid-1940s and expected to go beyond that. And I heard Bank of America's chief U.S. rate strategist, they did some work and said every $1 trillion of additional debt pushes up the 30-year rate about 9 basis points. Well, we're going to put nearly $2 trillion of new debt onto the market this year and every year after this, unless something changes. And that's over time, that's some significant pressure on longer term rates. And so that's just something to be aware of. Okay, let me shift then and talk a little bit about workforce. You can go to the next slide, and then I'll leave plenty of time for questions. There's a couple interesting issues in here to talk about. This is the level of employment nationally with the month-to-month changes in the box there. We had a wobble in October. We had a couple of hurricanes hit, including Helene here in Western North Carolina. And then we had the Boeing strike as well. That's all largely in the rearview mirror. I don't want to say Western North Carolina is fully recovered because they're not. Um, but the monthly jobs numbers since then have been pretty healthy. What's interesting, you note here, and again, that blue dotted line is not scientific. It just gives you an idea of trend. We've recovered onto a line that is parallel to the pre-COVID trend, but it doesn't look like we're going to close that gap. Part of that is demographics. Baby boomers are now, which is obviously a large generation. They extended their time in the workforce and now they are retiring in large numbers. And it looks like my generation, I'm at the front end of the Gen Xers. Looks like a good number of us have burned out and we're going to retire early. So there's two generations now that are on the cusp of retiring in bigger numbers or already are. So I think that's one thing that's going on here. It's a little different when you look at it at the state level on the next slide. North Carolina is a growing state. We have lots of people moving into the state. We've fully recovered to a pre-COVID trend for overall employment. And the first glance you look and say, okay, that's great. Labor should be abundant. But if you go to the next slide, there's a different way of looking at this that I think is relevant to this audience. So the blue line here is worker demand. So it is existing employment plus job openings, right? And that's actually gone sideways for a couple of years because job openings have come down. So employment's gone up, but job openings have softened to a significant degree. And that's helped close the gap between worker demand and the size of our labor force in the state. And you can see the labor force growth has flattened out a little bit for North Carolina in the last couple of years. But what's interesting is if you look back in time, other than the last couple of years before COVID, for most of the 15 years ahead before that, the labor force was outpacing labor demand. In other words, you as employers, if you needed a worker, you posted a job, went into the marketplace, and you just hired people at the going rate. That has reversed, and given demographics, is probably likely to stay that way for the foreseeable future, where demand is outstripping our workforce to some degree, which means you're going to have to think a little bit harder about how you source your labor, and you've had to do this for a number of years. So I think I'm just telling you, keep up what you're doing because your job's probably not over yet. Go to the next slide, please. One other piece of this is how manufacturing's labor force right now might be a little bit different than the nation as a whole in terms of how much slack there is. This is, economists love these charts. It's called the Beveridge curve. It's graphing the unemployment rate on the horizontal axis against the job openings rate vertically. And you've got a lot of history here. The blue and orange dots are sort of like normal periods, normal expansions that we've had. The dot that's all the way to the right is April 2020. That's the first full month of COVID data where we shut down huge chunks of our economy and the unemployment rate went to 15%. And then you can track from there. You could connect those dots as the unemployment rate comes down, and then eventually job openings pick up as you hit those purple dots. And then we came over to where the unemployment rate was around 4% and job openings were really high. And then over the last year and a half, we've basically just come down vertically, meaning the unemployment rate has remained really low, but job openings have started to come back to normal. And you can see November and December are highlighted. For the overall economy, we're just getting back into this normal range, right? The unemployment rate hasn't really budged, but job openings are now sort of where you'd expect them to be given the unemployment rate. If you go to the next slide, this one is specific to manufacturing. Same general pattern, but November and December are those two blue dots in there. You can see where December is. From November to December, and it's just 1 month, so I don't want to make too much of it. The job openings rate didn't change much, but within manufacturing, the unemployment rate went up some. This suggests to me that right now, the manufacturing sector has a little bit more slack on the labor side than does the overall US economy. Now, I know some of you would tell me, but I've got particular roles I'm still having a hard time filling. There's skilled manufacturing roles. Yes, that's true, but overall, it looks like this is much more a normal labor market right now, and we'll just have to follow this. All right, I'm probably going to go through a few slides here a little more quickly. You can go to the next slide. The purpose of this slide is to give you some labor force participation rates for different groups. The one on the top left is working age population, prime age workers, 25 to 54. Their labor, the percentage of them that are in, my apologies, that are in the labor force is pretty high. So there's probably not a lot of them to pull off the sidelines. To the right then is the 55 and over crowd, baby boomers, and the front end of Gen Xers. And you can see post-COVID, a lot of them went to the sidelines and they're staying there. Does it look, so is it hopeless? Not really. If you look at the bottom, both college and high school grads without college, their labor force participation rates could go up a little bit overall, but that, I should note, that also includes those who are over 55, right? The point is that I think there probably aren't as many workers to come off the sidelines as in the past. And then if you throw on top of that, fewer immigrants coming into the country, whatever type, legal or illegal, I think it makes it for a tighter labor market going forward. Next slide, please. I'm going to go through these really quick. You can look at these and if because you'll get these slides. I have a couple of slides here of regional employment. Go to the next. This one is just comparing states. If you go to the next one, it's comparing metropolitan areas. Love this slide. The horizontal is 1-year employment growth. The vertical is 10-year average employment growth. You can see where across the Carolinas the solid growth is. The ones vertically at the top are the ones that have been growing strongly for the last decade. Raleigh, Charleston, Charlotte, Wilmington's up there. The interesting ones actually are the ones that in the last year look good. Florence and Sumter, South Carolina among them, which is pretty interesting. Next slide, please. And this is just a different one, total employment change or percentage employment change since COVID hit by metropolitan area. On a percentage basis, Raleigh is the easy winner, but you can see where the rest of those fall out. I'll let you digest this on your own. Next slide, please, because I just want to make sure we have time for some questions. Wage growth. Our friends at the Atlanta Fed track wage growth by wage growth level. So these are four quartiles. They break it down. The first quartile is the lowest wage worker, and then second quartile is the next one. So the fourth quartile is the highest wage worker. This isn't manufacturing specific. I wish it was, but I think it's interesting, right? Coming out of COVID, and for the lowest quartile of wage earners, well before COVID, wage growth was stronger. If you go back to 2016, nationally, there was this movement, the fight for 15, right, to get workers to $15 an hour. For a lot of workers, maybe in smaller town rural areas, you still see 13 or 14. But for the most part, wage growth at that lower end has been enough to push us above that. All those wage growth rates have come down and they sort of have synchronized now. They're still above where they were pre-COVID for the most part, but this still might be largely consistent with 2% inflation. In other words, maybe wage growth at 4.5% is still okay with 2% inflation, because if you go to the next slide, productivity growth has resumed at a very healthy level, with the prospect of productivity growth being pretty solid going forward. Some of this is AI, but I think just more generally, I think there's amidst a worker shortage, I think there's a lot of incentive to pursue labor saving projects. I think, let me see, if you go to the next slide, I might be just about done. Yes, this is important. We would love if you want to participate in our surveys, which do not take a whole lot of time every month, and give you access to some special content. Once in a while, we get our president on a Zoom call with our survey participants to get his viewpoint directly. You're welcome to sign up and use that QR code. And with that, I'll stop and be happy to take any questions.
Matt, thank you so much. That was great information, insightful, fascinating, solid but uncertain. I noticed uncertainty throughout your presentation. So thank you for that. We do have a couple of questions. So Dana was kind enough to put in our chat that you can put your questions in Q&A. So we've had a couple, so we'll jump right into those. The first one is theories as to why North Carolina is leading in employment growth versus other states.
Yeah, good question. I get this one a fair amount. Both Carolinas have done a good job of being business friendly, and I'm not paid to advertise for the North Carolina Chamber, but between the North Carolina Chamber, local economic development, and the state government, right? They've made it easy for business to come here and work. And I think the track record matters here as well, right? Businesses can come in, they can find the workforce they need, which I think I would throw in then the community college system in North Carolina is a tremendous asset. And then we're in the South, right? You live in North Carolina, you can get to the beach, you can get to the mountains. That's a great asset. And the infrastructure is pretty good as well, right? Here in Charlotte, get a lot of discussion about the airport and the fact that business executives and others can get to customers and wherever they need to pretty easily because they can get out. And I know Raleigh Durham's getting more flights all the time to increase that connectivity as well. All those things matter. We got a chance to visit Toyota's battery plant late last year. That's a huge hiring lift in the middle of the state. And I was a little dubious about whether they were going to find the workers. Now they pay well, all of that. They don't seem to have any concerns. They're hiring as fast as they can. And I think a really big demonstration project like that probably helps for other bigger projects as well. But I think there's a lot of factors that come into play, and uh, so the momentum's there, and so businesses want to come and workers want to live in the state, and it works well.
Right. The secret is out. And thank you for the um, important business friendly thing that you noted there. That's exactly why we exist here at the NC Chamber. All right. Can you talk a little bit about the impacts of North Carolina's tight labor markets? Will North Carolina's tight labor market drive up labor prices, in parentheses, wages, thus making North Carolina products less competitive?
Yeah, I think there's a really important dynamic here. So we're able to get people to move to the state, right? So I think that helps. But I think demographics and the likelihood that the numbers on immigration are going to be less than they have been in recent years means that I think that labor is going to be tighter than maybe it has been in past cycles. And so the implication would be, yes, wage growth might be a little firmer than it was in past cycles. That doesn't mean it's going to be COVID crazy, right? Because it's going to depend on inflation. So if we do our job and inflation continues to moderate toward 2%, then as you think about merit pools and that sort of thing for years coming up, you your workers won't be able to come to you and say, well, prices of everything is going up. Prices have gone up and they're going to remain high. So that's still going to be a concern. And I think for lower income households, it seems to be particularly burdensome. So if I were to give my outlook for this, I would expect wage growth to be a little firmer than it was in the last couple of cycles, but not. I don't think it's a sea change difference. I think it's a marginal difference is the most likely outcome.
Great, thank you so much. We have one more question, so if anyone else has a question, please put it in our Q&A box. This one is number one piece of advice for North Carolina manufacturers moving further into 2025.
I'm not a manufacturer. I'm just an observer. So this is kind of hard. Uh, Maybe it would be to look through the noise. I think this is, again, I put the disclaimer at the beginning. I'll reemphasize it here. This is Matt Martin's view of the world, not anybody else's. Um, there's a lot of policy noise right now, but I do think at some point it settles in, right? We get a little bit more certainty. I think, mm, and I think the North Carolina Chamber and others will probably play a role in this. I think our members of Congress and the administration are going to get feedback over time that the uncertainty is a problem, right? If policy uncertainty continues and leads to delayed decision making. And so I think the incentives are going to be aligned to try and settle into something that's got a little bit more longevity that manufacturers can plan around. And so you know, again, unless another large risk materializes, which are out there, we're on a good footing, and the economy has a tendency to continue to grow unless something knocks it off course. So sort of look through the fog, and as you're thinking about the future, don't get too caught up in all the machinations that are taking place at the moment.
Right. I think that's so important. You even shared some intel today that we don't always think about, like exchange rate, that could be used when you're looking at tariffs. So a lot of great information.
Yeah, well, and that helps on the import side, but if you're a manufacturer who sells out overseas, then that could be a problem on your own pricing of the goods you're sending outside the country. So it's a double-edged sword.
True, very true. Well, great. Well, that is our last question. We don't have any more that have popped up. Matt, thank you again for joining us today. Just a lot of great intel, solid but uncertain, super helpful. We would also like to thank the manufacturers that were present today for all that you do to keep North Carolina's economic engines running. As we mentioned earlier, this council is open to NC Chamber Cornerstone members and up. Our members are diverse in location, size, and products that are made, and we are best poised to solve our complex problems when we are many voices in the room and many perspectives at the table. We welcome your participation and input, and we'll provide a way for guests to inquire about membership in the recap email, which will go out in a day or two. We also have additional events coming up, as you'll see on the slide in front of you. We would love to have you come and join us at any one of these. You can visit our website for more details. The GA event is next week, and as you note, the registration closes today, and that's looking at like 400 plus people. So please join us if you can. And then 2 more events follow that: our annual leadership dinner, where we provide awards to a public and private sector person who's had a significant impact in North Carolina. And then Building NC, all the things that Matt talked about. North Carolina is growing, and that creates opportunities as well as challenges, and that's coming up in April. We also invite you to join us for our very first Infrastructure and Supply Chain Council meeting in March. And this is modeled after our Manufacturing Council. It will meet regularly to explore solutions to supply chain and infrastructure challenges that impede the growth of our state's businesses. And the first meeting will be open to all stakeholders and will also be held virtually. And you can register for this on our website, or the recap email that I just mentioned will go out in the next day or two. Before we close out today's meeting, you'll be prompted to complete a survey about your experience today. Please take a few minutes to complete this and give us feedback. This is how we determine what our topics are in the future, and it would be great to hear from you all on what it is you'd like for us to provide intel and speakers on. Once again, thank you for joining us. We look forward to continuing to work on your behalf this year, and we thank you for all that you do to keep North Carolina moving forward. Hope everybody has a great day and that the weather isn't too bad for all of us. Thank you.